Hi. um, Welcome. We just started week 3 already, week 3 out of 8 for the course. Last week was ratio analysis. And in ratio analysis, we looked back over corporations' last years. And specifically, I'm saying years. So, versus the next module, we're going to be looking forward. We're going to be forecasting. So again, I want to emphasize the purpose of week 2 was to look at where a company's been. What are the trends and analysis, right? What's been happening? Um, what we want to do ideally in a corporation is dig into why things are why a gross margin is declining, why are operating margins increasing. We want to see why, right? That'd be the next step for to get a depiction of what's been happening for ratio analysis. Now, one thing I want to point out about the ratio analysis is that a lot of that should have been a review. You did a lot of that already in the previous class for financial accounting. So, what I would recommend is to attack your company you're going to be working on. You all, I think, as at this point, I think I got a company request from everybody. A couple of you I had to push back because we had like 3 people ask for the same company. So you're going to be taking that company and starting in a ratio analysis, just like you did in this past module. So you want to see what gross margin has been. You want to see what operating margin has been, net margin, just what have sales growth been, because you're going to need to do that for your final project. So I suggest doing it now, while it's still fresh in your head versus doing it week 6, week 7, and you're gonna have a lot of other things on your mind. So again, in the gross margin week 7, we're looking backward to see what the trends have been. We're comparing the company versus itself, right? This sequential idea. How did the company do versus last year versus the year before? 3, 4, 5 years are great. Companies are performing on a scale, lots of different macroeconomic factors. We've had one of the most tremendous economic booms ever in the last couple of years, and then in 2020, which you don't have numbers yet for, we have the biggest collapse of the economy probably ever. 40 million unemployment. And the other thing we want to compare to, and you'll want to do this on your final project, is compare your ratios of the company you're doing to a rival. And I'd be happy to help you find out what appropriate rival is. But one thing I do is go on Yahoo Finance, put in your company's name, and typically Yahoo Finance will show you what they consider the main rivals. And again, just send me an email, and I'll be happy to give you guys the best, the most appropriate metro. So again, think about what to do with the information that you have. Let's see. So for week 2, I want to just give feedback again to people. I did not make this course. I did not create this course. It's not perfect, so it's your responsibility to bring it up as soon as you can, that there's a problem, so then we can move forward in getting it corrected so you can have access to the module, okay? We're graduate students, and again, I apologize it didn't work, but again, every week we're going to have 2 posts. So if the 2 posts aren't there, you should say, oh, wait, there's only 1 post, okay? So week 3, let's transition to week 3. So week 3 is going to be called financial forecasting. So with financial forecasting, we're going from what happened before to taking that information and moving forward. So okay, now we know what the trends have been before. Now we're going to turn around and say, okay, what do we think it's going to be going forward? Specifically, this module, this chapter, really focuses on cash flow. So the last the ratio analysis looks at accounting ratios. We call them accounting ratios, right? At the end of the day, if you're the CFO, Chief Financial Officer, Treasurer, other positions where you're working with cash, you really, at the end of the day, you're really focused on cash. How much cash are we going to have for the next 6 months? And an example is accounts receivable. You could have sales, but the cash doesn't come in, so that's not going to help you with payroll. It's not going to help you with your expenses. It's not going to help you with paying interest, etc. So this module is going to use actually they'll call it financial statements, and the financial statements are a little different than what we said before of an income statement, balance sheet, statement of cash flows. This module is going to talk about a sales projection, production schedule, which is based on the sales, right? I'm gonna have this many sales. This is how many units I need to produce and the resources to make those. I need to compute other expenses, right? That's the third part of this process. And the fourth one is to determine profit. And profit in this case really means cash flow. If we're going to have negative cash flow, if we project that we might have negative cash flow, we got to figure out what we're going to do, right? How are we going to fill in the blanks? Because even though we're going to get paid back, we're going to get a big client's going to give us the money next month. This month I have payroll. This month I have bills to pay. Maybe I have a tax estimate to pay. So again, big transition from last module. We looked in the past, and now we're going to look in the future. We're going to look at 6 months. These modules are 6 months, and you need to start. It's actually 7 months because you need one additional month. You need an additional month because I got to start off on the trailing part of how much cash is coming in from sales in December, right? Sales in December, I'm still going to be getting cash in the next 2 months sometime. So think about that. Again, cash flow versus accounting. This course, while we need to definitely know all the accounting rules, financial analysts are really particularly interested in cash flow and cash in itself. So be conscious of that transition, being able to do both. This module initiates that for the first time. So if we are going to be called in the red, meaning we're going to be below zero for cash, what are we going to do? We need to know ahead of time, right? If I know I'm projecting I'm going to be below zero for cash, then I need to do something called line of credit. I know a couple of you have been in banking, so that might sound familiar, but I'm going to work out a deal with a bank, and the bank's going to automatically give me money for obviously for a fee and for interest, but that way I'm never going to be below zero. And in fact, a lot of companies have minimums. I think in the book, in this course, the scenario that's in the book says that the company always wants to have $50,000. So they never want to be below 50,000. So that means if they have 45,000 at the end of the month, they're going to actually borrow 5 more because they always want to have that cash level. And again, that's based on a whole bunch of years of activity, right? That's what the company feels comfortable with cash. Maybe the 50,000 enables them to take advantage of an opportunity too. Sometimes in accounts payable, if you pay your bills early, you can get a discount. So maybe that's a strategy from a CFO or a treasurer. So lastly, it focuses on we're creating what's called a pro forma income statement, right? With cash flow. So what we also need to be able to do too is if we're creating a financial statement that looks at money coming in and cash coming in and coming out, we also want to create a balance sheet, a what if balance sheet. So at the end of that month, we have a balance sheet going forward, a projected balance sheet and a projected income statement. So one of the ways to project the balance sheet is something called percentage of sales method. They also call that a common size. So you have a certain amount of sales, and then you say, okay, the balance sheet required to support that sales is going to look like this. This is how much cash we want. This is what current assets are. This is what long-term assets are. And the book shows you how to do that. But think about that again. It's all it is a percentage of the sales. All right. So as you're constructing one of these simplistic balance sheets, you're saying, okay, if my company's going to have this amount of sales, what are my assets, particularly short-term assets, short-term liabilities? What do I need to support that? So again, lastly, what I want to say is looks like we're doing pretty well. I'm keeping up with the statements. Don't be afraid to push yourself a little more on the statements. If you have an idea or there's a current event about something that we're talking about, pro formas. I mean, think about pro formas right now. COVID-19 hit us. How many businesses have had to totally change their short-term forecasts, right, based in the first quarter? Everybody's having to do this. Think about examples. Maybe you work some places that are going to be affected by cash flow. I'd love to see you guys bringing that to the table in our conversations. Okay, I apologize I wasn't on the conversations as much, but I will this coming week. All right. So again, if you have any questions, let me know if I can add any, give you any additional help on the content. But it's pretty straightforward this week, and keep up your good work.